Okay, let's get started. Thanks very much for coming out. I'm here with some folks from Oaktree, and I'm going to just briefly introduce them and then let them take the stage. Here with Dean Hollis, a senior advisor with Oaktree, David Tanner, managing director, portfolio enhancement team, and Matt Wilson, managing director and co-portfolio manager. So, fellows, you got the stage.
Thank you. Good morning, everybody. It's good to be back into Boston. I went to school here 15 years ago, and when I arrived from Los Angeles yesterday, it was nice to see 25 degrees and sideways blowing snow in the first week of April. It's good to know certain things don't change over time. We're excited to be here today to talk a little bit about how we do things differently at Oaktree. I'm joined by my two partners, and we're going to talk about a company called Diamond Foods, which is a deal we executed in 2012 and most recently exited over the last several months. Let me give you a few minutes on Oaktree just very quickly. For those not familiar, Oaktree was formed about 20 years ago and started out with about $5 billion of assets in our first year. Over the last 2 decades, we've grown to roughly $100 billion of assets and 24 strategies focused on credit and equities. At the core of the Oaktree philosophy is a view of mitigating risk. When you come into our investment committees, no matter what strategy it is, the first question we talk about is how we're not going to lose our clients' money. It's absolutely focused on downside protection, risk mitigation, and we have a philosophy that says if you avoid the losers, the winners will often take care of themselves. And we're certainly not trying to be the highest return fund in every cycle. What we're looking for is consistency of returns. We're looking to make sure we make money in every cycle for our clients. And we tend to do very well in times when others are facing significant distress in their funds. We don't chase the market up, and we protect ourselves when the market goes down and often take advantage of those times to create very interesting investments with very good risk profiles. I'll leave that as a backdrop for the Diamond deal today because I think when you understand this transaction and how we structured it and the price we paid, it really is right down the middle of the fairway for Oaktree in terms of risk and return. And that kind of asymmetry is what we really like to accomplish at Oaktree. Talking about our group in particular, I took over leadership with my partner Jordan Cruz at the end of last year, and really back in the middle of 2014 when Jordan and I were named co-portfolio managers, we began the leadership of what is called the Global Principal Group. And this is Oaktree's best analog to private equity. And I say analog because we don't do leveraged buyouts, we don't participate in auctions, we don't do venture capital growth equity. We really do 3 things. It's not a coincidence we do these 3 things. When Jordan and I sat down, our view was to look back at our track records and figure out where it was that we could make money and where we differentiate ourselves from both a sourcing and execution point of view. And those 3 buckets are distress for control. That's where we buy secured or unsecured bank debt, and we buy lots of it with the intention of restructuring that into the equity. We call it a deleveraging LBO in a lot of ways. Structured equity or rescue financing, what Diamond Foods is here today. We'll talk about that deal, but this is where we go in and put a piece of capital into the capital structure, typically at a priority position to existing equity. And that has the downside protection and all the structural seniority of a debt or preferred equity security, so it gives us that cushion or margin of safety. But at the same time, we structure these with the ability to participate in the equity in a significant way if things turn around, and we commit our resources operationally and industry expertise-wise to help us improve those businesses. The last thing we do are what we call direct equity platform investments, and this is typically us going out into the marketplace, buying distressed assets, hard assets, oftentimes on a de novo basis with a management team that has proven themselves successful in that industry. And we're able to buy those individual assets oftentimes at a significant discount to what we believe their mid-cycle net asset value looks like, put great management around them, put our portfolio enhancement team with them, and then build them into very attractive companies. We have an integrated approach to everything we do at Oaktree on the principal side. We call it the deal triangle. There are 3 legs of the triangle. The first is the investment team, someone like myself who's been trained to be an investor, who knows how to do structures, who understands an industry, who understands how to put all the pieces of the puzzle together and try to connect the dots on the transactional side. And we pair that investor up with someone who's got deep industry expertise. Dean Hollis, my partner here, has been in the food industry for 30 years. he will know more, or he'll forget more about food than I'll ever know, but we have his expertise from the first day we look at an opportunity, and it allows us to be very quick in making decisions on whether or not to pursue an asset or not. For us, the idea of stage gating, to manage your time properly, not to waste time on things that aren't going to go where, it's a very important skill to have in this business, and Dean helps us get to very quick answers. David Tanner represents the portfolio enhancement side of our team. This is a group of in-house professionals that are former consultants in many cases that come in and help lead the operational turnaround of these assets when we buy them. And so if you think about what we do, we bring in investment expertise, industry expertise, and an operator that can come in and own that turnaround plan, and we underwrite every deal in a way that we're all shaking hands and locking arms going into the deal, that we're going to do something together and create that. Dean, you want to speak up?
Yeah, I think as Matt said, I've spent my entire life in the CPG or consumer packaged goods space. First half of my life on the retail side and the second half on the manufacturing side. So that gives me a lot of experience, a lot of relationships, and a lot of knowledge within this industry, so we can immediately kind of jump through some of the initial hoops and not have to worry about outlining the category or overviewing the industry or overviewing the brands. We have those relationships, and we'll use Diamond as a classic example of how that's a differentiator for Oaktree.
And then I'll just give you a quick overview of the portfolio enhancement team. Like Matt said, the portfolio enhancement team is an internal group of senior operating executives at Oaktree that specialize in partnering with our portfolio companies to drive performance improvement with the particular expertise in turnaround situations. We've got on the team the capability to serve the broad range of industries and functions that we deal with across our portfolio. We do interim management and advisory work with our portfolio company management teams across a range of issues, anything from corporate strategy to cost cutting to supply chain redesign to commercial issues like pricing, sales force effectiveness to corporate governance, talent issues. We work across a range of activities there. The members of the team by design have a blend of management consulting and operating executive experience. We think it's important that you have the toolkit in the client hands and the broad exposure that you get as a management consultant, but at the same time we think it's important that you've had to be a senior operator in a company and know what it's like to drive change and how hard it is, so you have a realistic calibration of what you can actually implement when you do drive change. And then finally, we use what we call as a high leverage model. We've got relationships with a lot of the top consulting firms around the world where we know for a certain industry functional issue, we know the right partners to go in the right consulting firms, and we frequently bring consultants in to help give us leverage and accelerate the change in our companies, and we'll talk through that today at Diamond.
Great, thanks, Dave. Okay, so hopefully that's a clear picture of who we are and a little bit of a high-level picture of the philosophy that Oaktree espouses in terms of risk mitigation and how we invest. So let's take this to a very specific example, and I'll set this up by just giving you a quick background on Diamond Foods. Diamond was a public company. If you go way back in time, it started as a sleepy walnut cooperative up in the Central Valley of Northern California. As you moved into the last decade, in the mid-2000s, the company hired a very young and aggressive CEO who decided he didn't want this to be a sleepy cooperative. He moved the headquarters from Stockton, California, to the Pyramid in San Francisco. He took the company public, and he used that currency to go out and create a portfolio of CPG, consumer packaged good brands, and in the process transformed what would be a lower multiple kind of stable ag business into an exciting high growth salty snack business, which is one of the better segments in the food markets today. If you just look at the company overview, it was roughly just under $1 billion of sales at the time we got involved. It shrunk over time, and we'll talk about why it shrunk, but we got out of a lot of unprofitable lines they had. But at the core of the business, you had a number of really exciting brands in there. Kettle potato chips is one of the most exciting brands in the all-natural space. It's one we think with absolute global potential to be a big name. It was bought by the company as part of their roll-up strategy. Pop Secret is a at-home popcorn. If you ever watch a movie with your kids at home and you make it in the microwave, there's really a duopoly between them and Orville Redenbacher. The market shares are very stable. The margins are very high. So it was a pretty exciting cash flow category. Diamond of California had a 35 share of the baking nuts aisle, so that anyone who makes pies or enjoys the holidays, that 3 months of the year when everyone's baking in the U.S., this is a very, very attractive business, both from a margin and from a market share point of view. And finally, Emerald was an emerging brand that was in the snack bud nuts business that the company was building over time. The company itself was a high flyer. As we'll see in a couple of minutes on the stock price chart, this was one of the most exciting food companies in the marketplace last decade. So let's talk a little bit about the background of kind of what went wrong, since everything seems to be kind of working the right way. In September of 2011, Diamond had gone down a path of trying to buy Pringles from Procter & Gamble. And without going into some real specifics on tax structure, let's just say they had put together a deal that was probably attractive from the point of view of Procter & Gamble, because they were able to use what's called a reverse Morris trust format, which allowed them to do it tax-free. Had Procter wanted to sell Pringles, they would have to pay a large tax bill as an asset sale because the basis was near zero. So Diamond was the preferred suitor for Pringles, and it put together a transaction that was very exciting to the marketplace. As I said, this was the hottest food company in 2011. The stock market loved what they were doing, and here was a company buying a company literally 3 times its size. So everything's going well until that fall, an independent research equity analyst raised some questions about the accounting on one of Diamond's legacy segments, the walnut business, which is what this all evolved from in the historical period. And the analyst basically alleged that certain payments in that period were misallocated. And the effect of this was that it meant the numbers were potentially overstated. And what that meant was that the Procter deal that was contingent upon a stock-for-stock ratio to work, Procter was getting stock back that was overvalued based on the earnings profile. So the Diamond board did what they were supposed to do. They conducted an internal investigation. And after about 2 months, the audit committee chairman determined that, in fact, there had been some impropriety around the accounting, and in fact that they would need to terminate the Pringles deal as a result of this. So you can imagine this is a big thud noise that you hear. The company had already begun the integration process, had spent probably $50 or $60 million preparing to become a global business. The management team outside of the top 2 executives were wholly unaware of this investigation going on. And for anyone else from the outside looking in, things were business as usual. Well, unfortunately, the result of that investigation caused the company to delay its 10Q filing that fall. It determined that, in fact, as I said a minute ago, that the payments were made in improper periods. That led to the termination of both the CEO and the CFO. It led to a default of 22 different provisions under its credit facility. Obviously, the merger was no longer taking place. And you had an employee base that was sort of standing there looking around the room, not understanding how this could have possibly happened to them. It was very much a shock to the system, a very scary time for Diamond. And I will tell you, from the capital markets point of view, no one saw this coming. Not the equity markets, not the lenders. No one involved had seen this coming. And of course, when EBITDA gets restated, it doesn't get restated back up, it gets restated down. So for the lenders who were involved, who believed they were lending at a conservative level, a ratio of debt sub 4 times, they now found themselves almost leveraged 7 times in this capital structure. No one wanted to put money into the situation. So as we at Oaktree say, when everybody was running for the exits, we saw a really, really good opportunity to get involved. Turn the slide here just to give you a perspective of how this played out in the public marketplace. If you look at the stock price chart here, you get a real sense of how this went wrong. At the peak, the stock was almost at $100 a share. But as these allegations began to leak out into the market, and then eventually with the confirmation of these allegations, the stock dropped to around $20 a share from the mid-90s. And it's as high as this thing had flown, and as fast as it had risen, it came down just as quickly in the period of the end of 2011. And for us at Oaktree, one of the things we do in our group is to try to think about where the puck's going to be, not where it's today. And we've been watching the situation very closely, working with Dean, as we'd heard the same rumblings in the marketplace. And when it became clear that they were terminating the merger with Procter & Gamble and Pringles, we knew something was going to be available to us to do, because we knew that the capital structure couldn't be sustained with the defaults they had. And when you layer on top of that, the company was coming to a point in its cycle where they needed a significant amount of liquidity to make payments to their growers, and they were frozen out of all of the capital markets at this point in time. For us, these are very exciting opportunities, right? When the world is in a place where things look darkest, we think we can go in and figure out ways to solve those problems and create investment opportunities for ourselves. So let's talk about what we did. Let's talk about the structure. In our experience, it takes sometimes, for some of these high flyers, it takes a while for the realization to kick in that this has actually happened. And that was no different here. We had done a fair bit of due diligence with the leading consulting firm that we have on retainer, and we had gone and figured out that their business was nowhere near what they were telling the street. We had talked to, as an example, 70 out of 100 of their top growers on the walnut side of the business, but on a dollar volume basis, it was more like 95% of those growers. And we had calculated that their estimates for the street were wildly off. In fact, the board itself did not understand this. In fact, the management team did not believe this. So we had a very much a different view of what was going on in the business than I think what was actually internally believed by both the board and the management team. And that the more we looked at this opportunity, we saw both good news and bad news. The bad news was, I think we thought this was much worse than anyone else thought it was. The good news was all of these issues were self-inflicted, and in a lot of cases, a lot of these acquisitions they made were never properly integrated, meaning there was huge upside for someone to come in and actually do that heavy lifting, that kind of work, which we do. And so in response, we structured a security and approached the board because we had an asymmetric view of what the deal looked like. We told the board that if you're right, we'll give you one security, and we'll flip into that. If we're right, we want this security because the risk profile is what we think. And I can tell you, the investment banker and the board that sat there thought this was the best idea of all time. They were 100% certain that they were going to make their numbers, that their team was right, and we were 100% certain that they were not going to make their numbers. And so, like any other thing you do in life, it's very rare that you're able to do this, and particularly in a public company context, to make these trades. But we thought that if they were able to achieve those targets at the right profit levels, that it was a different risk profile for us too, and we'd be willing to make that trade. So we structured a security that we put in $225 million. We put it in as debt. And it's important to understand that even though this behaved like equity, we put it in as debt because in some kind of liquidation or wind down, we needed to be in a priority position. A separate and aside from that, the public shareholders, led by one of the state pension funds, had filed a class action lawsuit against the company. And had we put this in as common equity, we would have been subject to the same risk of being sued and diluted the way that all the other common shareholders were. We couldn't put ourselves in that position with new money. So we had to have a priority position. And I'm going to come back to this because this is a very important point about valuation. It's a very important point about structure. But the way that this was set up, we would get 12% annually in a PIK security, meaning it would be paid in kind. We had 112% prepayment penalty after the first year, as long as the company did not make the earnings targets that we didn't think they were going to make. However, if the company did succeed and they were able to achieve what they thought, we would convert this into a much less onerous preferred security, one where the dilution would be less to the shareholders and we would get less of an upside. But that said, from our point of view, it was fine because the risk profile would be much different than we thought it was. We would have been wrong on our due diligence, and in that case, we would have been in a situation where it was a less risky asset for us. Everybody signed on to this. Important to know here that in our model in private equity at Oaktree, we look for control or significant influence. So as part of this deal, we also required the right to appoint the CEO and 2 board seats, myself and Dean Hollis, to take on an 8-person board. So if you think about it, we had warrants for about 20% of the company. We had the debt security that funded liquidity. We had the CEO that we appointed, and then we had 2 other board seats. We felt like we had a lot of control. Not to mention that if you're a student of any kind of credit documents, this indenture is a fun one to read. You know, the joke was that they couldn't turn off the light switch without calling Oaktree to do so, and it was fairly onerous in that. But we needed to have the protection that in the first year of this investment, that we could exercise whatever we needed to, or we could block things as we needed to protect ourselves. And so when I take a step back and look at this, and I look at our competition, that who was looking at this, on the one hand, you had the private equity world, the large cap LBO players were all trying to figure out, how do we buy this asset? And the answer is, you really could not have done that because you could not quantify the risk of a black swan scenario where you bought this, the class action litigation was at a value way above what you thought, and then therefore you had to file bankruptcy. You would be at risk of losing all of your money to do that. There's also a world of distressed debt players, folks who don't bring in the operating teams. They don't bring in Dean Hollis on the board. They're not able to bring a cadre of CEOs they've worked for before, but they've capital, high rate capital. Those folks were competing with us as well. What we do well at Oaktree in this group is we find the intersection between distressed debt and private equity. In other words, we know how to structure the security like the distressed player, but we bring the operational resources, the governance, and the leadership that a private equity group brings. And in this case, in this company, this board needed that very much. So let's talk about what we liked about it. Maybe, Dean, I'll turn it over to you.
Yeah, and I think there's a couple of things that being in an industry as long as I was and having the relationship and knowledge that we really like this category. I mean, the snack category in the better for you snack category was extremely attractive to us. We knew the brands. I'd competed against the brands at various times in my career. I'd looked at actually acquiring the brands. So I was very familiar with the categories and very familiar with the brands. And it allowed us to quickly go to a due diligence. And having worked in this industry my entire life and spent 22 years at ConAgra and as President Chief Operating Officer before working the last 8 years with Oaktree, gave us a lot of knowledge and a lot of expertise and kind of got us to the front of the pack, if you will. Actually, Rick Walford, who the board had appointed as interim CEO, and I had known each other for many, many years, had served on many industry advisory councils together. So I was able to call Rick and kind of get us to the head of the class, if you will. And that gave us immediate credibility and immediate access, because Rick and I did know each other. He knew that I was familiar with the industry, and it gave us a kind of a trusted advisor as opposed to them feeling like the vultures were just circling and not knowing who to turn to and trust. So that enabled us to, as Matt said earlier, do some really quick due diligence. We knew who the growers were. We knew who the customers were. We knew who their competitors were. So we didn't have to spend a lot of time on that part of our due diligence. And it really enabled us to focus on three things, which is what we really do as we look at investments. One is the portfolio. We knew the portfolio, we knew of the portfolio, we knew the brand, so we knew the portfolio was healthy, and it was all self-inflicted wounds. So we were able to check the portfolio box very quickly and know that we had material upside both from a cost savings and from a revenue standpoint. That enabled us to go to the people, which is the number two. As Matt said, the board had selected a CEO to come in and run Diamond. I knew the person, a very capable CEO, just wasn't the right fit for this company. So we were able to pass that along to the board. They did some discovery due diligence, agreed with us, and within days, literally from a Friday to a Monday, we had recruited, hired, and brought on board Brian Driscoll, the new CEO. So we were able to check the people box. And then we were able to focus really on the process. And as Matt said earlier, these guys were on an acquisition rocket ship. The problem is they never integrated any of them. They were all self-standing units. The people were kind of shell-shocked with everything that had gone on. And that's when we really engaged with Dave Tanner and the PET team from the beginning to really put together our thesis and to make sure that we had the right portfolio, people, and process. And that just didn't stop in the due diligence phase. As we got in, and actually as we were come on board and establish ourselves on the board, we were able to bring in Dave Colo, who had worked for me for years at ConAgra as a senior supply chain guy that got our supply chain efforts underway, eventually became the COO. Ray Silcock, who we brought in as the CFO, a very well-known, very well-respected industry veteran. So we continued to upgrade the people. We continued to look and upgrade the portfolio as we made acquisitions and ultimately how we transacted the business. And more importantly, interacted and engaged with Dave's team in making sure we had the right processes in place. Because it wasn't that they had bad processes, they just didn't exist. And that's when Dave and the PET team was able to come in and actually put the controls, put the measurements, put the process in place, and allowed them to actually run the business the right way.
Why don't you jump to the next slide? And as Dean said, myself, my team, and a range of external advisors joined the deal team really early on here and was hand in hand all the way. And what you're seeing on this slide is, kind of the state of the organization when we went in there from an operational perspective. Suffice it to say, I went in, day one with Brian Driscoll, arm in arm, and we found a little bit of a smoking hole of an organization. It was pretty rudderless at the time, as you can imagine, and traumatized, given the CEO, the CFO had got blown out, the stock had come down from 90 to 20. So you had an organization that was, traumatized and disarray and pretty operationally and financially undisciplined. I'll let you guys read what's here on the slide, but I think a couple, stories around it. First, amazingly, when we went into the organization, there was not a single person in the organization who owned P&L responsibility for each of the major brands. And not only, which is, a big deal, but not only that, there was no one that had visibility of the P&Ls of the individual brands. They didn't even understand the profitability of their 4 brands broken down by brand, which was pretty startling. In the lower left there around the Emerald brand, and Matt talked about the creation of this brand, they were growing it as fast as they could, but it was a negative gross margin brand. So they're growing their losses as quickly as they could. So a range of issues we diagnosed out of the gate, but at the end of the day, we had an organization with sliding earnings, limited capabilities, and a state of disarray. What we did about it, next slide, Matt, if you can go to it, is we structured a turnaround program that I sat up at the top with Brian and the leadership team for over a year, shoulder to shoulder with them, with a bunch of different work streams to remediate the issues. I'm not going to read all these to you, but there was a bunch of stuff, surgery around the commercial side of the business on the left, from completely reconfiguring the Emerald brand, rationalization of SKUs, pricing, packaging changes, ingredient changes to actually make that a positive gross margin and growing brand. Re-architecting how the commercial processes in this business work. We reorged what was a siloed sales and marketing organization that didn't talk to each other into what's called a category business team, where you have cross-functional leadership over the brands. We redefined how we rebased the brand strategies for the major brands, invested heavily in innovation, and put a lot of discipline around a trade spend system that they basically had $200 million of trade spend that was ineffective and haphazardly spent, and we put all kinds of controls and processes around that. In the middle, we did a bunch of stuff on the supply chain, one on offense with grower relations. When we got in there, they weren't even talking to their growers, which were the lifeblood of their company, of their cash flow. We created all kinds of incentive programs and an offensive grower relations program. And then we did a bunch of stuff that basically made it a functioning supply chain, integrated the businesses, closed plants, created centralized procurement, things you would see in a classic, well-oiled operational organization. That was supported by our relationship with AlixPartners. I forgot to mention on the left, all the commercial stuff was supported by our relationship with McKinsey. And then on the right, we did a lot of things to kind of increase human capital productivity that weren't in place, from performance management systems to redesigning incentive systems to communications program, which is critical in any turnaround. So it was a structured, resourced, integrated turnaround program that I dropped into the company with basically 90% of my time for a year. It yielded over $40 million of EBITDA improvement in the first year, which probably would have been more if it wasn't for walnut supply and pricing issues. And then we intentionally, as Dean said, recruited through Dean's network, Dave Colo, who became COO of the organization, to take the baton from me, and he managed it from there.
So just to bring it all together, the performance improvement that happened was very dramatic. As you can see in the slide, that we grew EBITDA by over 55% in 3 years. As Dave points out, that's net of significant commodity headwinds that hit the industry in that period of time. So obviously, a lot of that is masking some of the operational improvements that have taken place there. The good news for the company was it was able to settle the litigation that had existed right in the realm of where we thought. And one of the things we did in this deal also is we put a provision in on our warrants that to the extent that they took us out in before year 9, we would get the Black-Scholes value of those warrants if we didn't exercise them. This allowed us to have some leverage, and they wanted to clean up the entire capital structure as part of the refinancing in 2014. If you fast forward to last fall, it became clear to us that as a billion-dollar food company, the world was consolidating around us, and all of the industry trends were aligning around bigger, better, diverse portfolios. We decided to explore the marketplace, and I helped lead the transaction committee of the board that ultimately led to the sale to Snyder-Lance last October. Do we have time for questions? Or please.
I know initially earlier in your presentation you said that you structured it as a PIK investment. So did you actually, because you had some lack of transparency into some of the financial risks, it sounds like, did you build in covenants at all in that instrument in addition to
Yeah, we did. I mean, so a couple things. One, we had full transparency. I mean, by the time we got in there, the accountants had restated the numbers, so we were able to we went private on the name, so we were able to see all of that. So we would not put ourselves in a position to buy something where there was accounting misstatements without the ability to do our own analysis. So our accountants had fully scrubbed those numbers. One of the things I didn't talk about, though, it's interesting, we then negotiated the rest of the banks into a much better deal. We got a covenant holiday from the senior banks above us, which again was helpful to the company, but also very helpful to us to protect ourselves from there. But yes, we had significant negative controls and negative covenants built into our document around a number of different things. Thank you. Thank you for your time, and I think lunch is next on the docket.